If you own VOO or VTI, you've made one of the best decisions any investor can ever make. That single move has built more retirement wealth over the last decade than just about any other. But this is the part that doesn't get talked about. The ETF that won the last decade is not necessarily the only ETF you need for the next one. The market is shifting, and 3 Vanguard ETFs are positioned to beat the S&P 500 from here through 2036. The third one is the pick almost nobody is talking about, so stay with me. What most VOO holders don't realize is that the S&P 500 is market cap weighted, which means the biggest companies get the biggest slice. So when mega cap tech leads the market, VOO leads with it. When mega cap tech corrects, VOO corrects with it. That's not a flaw, it's just less diversified than the name S&P 500 suggests. The 3 Vanguard ETFs we're about to break down are not replacements for VOO. They are satellites that surround it, each one positioned on a structural shift the next decade is likely to reward. Let's get into them. ETF number 1, the Vanguard Information Technology ETF, ticker VGT. I know. We all know the Vanguard top tech. This is the AI play, but it's the disciplined version. VGT holds 323 US tech stocks, and the top 10 make up about 59% of the fund. Yes, that's concentrated, but it's concentrated in the right names. Nvidia at 18.6%, Apple at 15.9%, Microsoft at 10.2%, Broadcom at 4.4%. These 4 companies are the rails the entire AI economy is being built on. Performance has been remarkable. Over the last 3 years, VGT has returned 28% annualized. Over 5 years, 15.9% annualized. Year-to-date through May, it's up over 20%. The S&P 500 has not come close, and it costs you 0.09% a year. On a $10,000 investment, that's $9 in annual fees. You're paying less to hold the most important companies in the world than you'd spend on one decent coffee a month. The honest catch: concentration cuts both ways. When tech leads, VGT crushes the S&P. When tech corrects, VGT corrects harder. So this is your conviction position. If you believe the AI build-out has another 5 to 7 years to run, VGT is the satellite that does the heavy lifting around your VOO core. ETF number 2, the Vanguard Dividend Appreciation ETF, ticker VIG. And this might be the most underrated fund in the entire Vanguard lineup. When most people hear dividend ETF, they think high yield, big monthly payouts, cash flow. VIG is not that. VIG only holds companies that have raised their dividend for at least 10 consecutive years in a row. That filter alone strips out the weak hands and leaves you with 333 of the highest quality American businesses. Look at the top holdings: Broadcom at 4.1%, Apple at 4.0%, Microsoft at 3.8%, JP Morgan at 3.5%, Eli Lilly at 3.5%. 3 of the top 5 are tech. VIG is a dividend ETF with a serious technology tilt, which is exactly why it keeps pace with the market while still paying you. Current yield is around 1.5%, and the expense ratio is 0.04%. That's $4 a year on a $10,000 position. Vanguard is practically running this fund for free. Over 3 years, VIG has returned 15.8% annualized. But here's what matters more. Beta is 0.79, meaning VIG moves about 21% less than the broader market. So if you're in your 50s or 60s, building toward retirement, and you want growth that doesn't punish you in the next downturn, VIG is built for exactly that role. This is the quality stabilizer. Before I get to number 3, and this is the one most ETF videos completely miss, if this is helping you, hit subscribe. It shows YouTube you love making money, and the Growth ETF Showdown is coming next after this video, and you don't want to miss that. Let's get back to it. ETF number 3, the Vanguard Small Cap Growth ETF, ticker VBK. The contrarian pick. Small caps have been left for dead. For most of the last decade, large cap tech ate the market, and small companies got ignored. That's exactly why VBK is set up to lead the next one. VBK tracks the CRSPUS Small Cap Growth Index, 557 small American companies on the faster-growing side of the market. And the diversification here is the cleanest you'll find anywhere. The top 10 holdings combined are only 8.4% of the fund. Technip FMC, Sienna, Casey's General Stores, Natera, FTAI Aviation. No single position above 0.9%. Compare that to VGT, where the top holding alone is 18.6%, and you're looking at two completely different risk profiles in one portfolio. Expense ratio, 0.05%, $5 a year on $10,000. Year to date, VBK is up nearly 12%. Here's the thesis. Small caps trade at a valuation discount to large caps that hasn't been this wide in over 20 years. Every time that gap has stretched this far historically, small caps eventually outran large caps for a multi-year stretch. Combine that with a Fed that's eventually going to ease and an economy broadening beyond the mega caps, and you have a setup investors don't see often. The honest catch? Small caps are volatile. You will see drawdowns. But if you have a 5-year horizon or longer, this is where the alpha is hiding.
So which one wins? That depends on who you are. If you're younger, you have a long runway and you believe in the AI thesis. VGT is the engine. If you're in your 50s or 60s, building toward retirement and you want growth without sleepless nights, VIG. The quality, the dividend growth, and the lower beta were built for this stage of life. If you can stomach volatility and you want the most asymmetric setup on this list, VBK. This is the satellite that could surprise everyone if the market broadens out. But here's where it gets interesting. You don't actually have to pick just one. An equal weight of all three, VGT, VIG, and VBK, alongside your VOO core gives you AI exposure, dividend stability, and small cap upside. 3 engines pulling from 3 different directions. That is the combination most likely to beat the S&P 500 over the next decade, because no single ETF wins every cycle, but a portfolio built with intention can win across all of them.